Hi everyone, Jeni Wilcock, one of the directors at Sullivan. We're chartered accountants located in Caringbah. How's my voice reaching the back? Good? Okay, so I don't think I'll use the mic today if everyone can hear. So there's been a lot of changes in the area of superannuation lately, as we've all heard in the press. Before I go on, as with any presentation, we need to give a disclaimer. So all the advice that I'm giving you today is general advice. So when you're after specific advice about your circumstances, come and speak to us separately. So we had a budget, as we do every year. May last year we had our Treasurer Scott Morrison announce some changes to superannuation, and a lot of controversy came out of those changes. A lot of discussion came out of those changes. So in a way he painted the town red with superannuation. So I like a few graphics in my slides, so you're allowed to chuckle as we go along. It doesn't have to be too heavy. So after he announced the changes, there was a lot of debate within the community. So we had a lot of lobbying of the politicians. There was lots of people quite unhappy with the changes that they had proposed. When they finally got these changes in a new form through Parliament, they then decided on some new rules, and rules that fairly greatly affect our superannuation. So what I'm going to be working with you today on is what those new rules are, how they impact on you, and what strategies you can be using to make the best out of those changes. So specifically, we'll be looking at the changing contribution caps. We'll be looking at the new member balance cap of 1.6 mil. We'll be looking at the two different types of pensions that there are. We'll also be looking at the tax-free pension asset value of 1.6 mil. And then, of course, talking about some strategies on how you can utilise these new rules. So are we okay so far? Does everyone need a wriggle? Are we all nice and wide awake after our excellent share market tips this morning? Okay, so the new super tax rules. The first thing that we're going to have a look at, and I'm a bit of a wanderer, so if I move around, you'll know what I'm doing. So we have some new rules. Can everyone see the screen well enough? If not, you have a handout in your pack, and you can take notes on that handout if you choose to. So what we have in the current year is we have an amount that we can put into superannuation, and that's called a concessional contribution. This is the amount that you get a tax deduction for when you put money into super. So currently in this year, if you are under 50 years of age, you can contribute $30,000 to super. If you're over 50 years of age, you can contribute $35,000 to super. So most of you will be aware of this rule. But the change that we've got, now when you see a stop sign, that means that we've got a change and we need to take a bit of notice. So I'm very subtle, aren't I? Is that nice and subtle, our stop sign? So the change that we have got is from 1 July, our super contribution level drops down to $25,000. So if you're in the over 50 age category, there's $10,000 less a year that you can put into super. So are most people aware of this? Let's see a show of hands. Yeah, a few nods around the room. Okay, that's great. So very important strategies for this financial year where you can get the maximum into super, because again, we've got the lower balance coming up. There's a second category of contributions that we can get into superannuation. They're called non-concessional contributions. Now, these NCCs are something that you don't get a tax deduction for, but it's the way that you get large amounts of money into super. And in the current year, we have a limit per person of $180,000 that can go into super. There's a special rule that's called the 3-year rule that says you can bring forward 3 years worth of contributions and you can put $540,000 in. Now, if you've done that in the past, then there's some special rules that we need to look at. But if you've never put any NCCs into super, this current year you can put $540,000 in. I'll talk a bit more as we go about the opportunity of that, but this is the rule that's changing. If you are aged over 65, you can still contribute $180,000, but you must satisfy the work test. Now, the work test says that you have to work 40 hours in a 30-day period to be able to put the $180,000 in. And if you are over 65 years of age, you can't use that 3-year bring forward rule. We good with that? If you have any questions, I'll let Terry answer them. Don't know what that is, Jen. It's all right, it's gone. Okay, so that's in the current financial year. Our $180,000 or $540,000 applies for this current financial year. The big change happens from 1 July. That contribution limit drops to $100,000. We still have our 3-year bring forward rule, but the maximum that you can put in over that 3-year period drops to $300,000, down from $540,000. Now again, if you are age 65 and above, you can put your $100,000 in if you satisfy that work test. So we've got a lot of clients that we work very strategically with to get maximum amounts of money into their superannuation fund. And one of the prime reasons that we do that is the concessional tax treatment within these funds. So within a self-managed super fund, or within any superannuation fund, you pay tax at 15% on earnings and 10% on capital gains while you're in what we call the accumulation phase, just the phase while you're working. Of course, when you move to the retirement age, you are usually able to access the zero rate in super funds and pay no tax on your earnings and no tax on your capital gains. So this is one of the reasons why we are quite pro getting a lot of money into super where it's possible. Now, this is one of our new rules coming out. So what's interesting is that we have 2 main changes into super. One is how much you can put into super, and then the other is how much will ultimately be tax-free. Now, in the government's infinite wisdom, they've chosen to use the same number for both of these caps. So when you see 1.6, it means 2 separate things. The first thing that it means is that each member's balance, if it exceeds 1.6 mil, it means then that in the future you can no longer put any further non-concessional contributions into super. You can still put your concessional contributions, which will be your $25,000 per year, but you can't put any contributions above that once you reach 1.6 mil. Now, one of the only ways around that is if you run a small business or if you own a commercial property that is rented by your business, if you sell those assets and you can access the CGT small business concessions, you can contribute through that method. But in the future, this is per member, this is not per fund. So in the future, if your member balance exceeds 1.6 mil, you're going to be limited to whatever your employer contributions are, which is up to your $25,000 limit. Is that making sense? Yeah? Okay. There is a small strategy that can be used. So if, for instance, your particular member balance is getting close to 1.6 mil, you can actually split your contributions across to, say, your spouse, if your spouse is in your fund with you. So if your member balance is 1.4, let's say, and you know you want to keep contributing for a little while, but your spouse's balance is maybe 300,000 or 400,000, the contributions that go in from your employer can be allocated across to your spouse. These are the after-tax contributions. This is just one little strategy that we use to help even up those member balances. In the past, we had something in superannuation called a reasonable benefit limit, and that was an amount basically that people were allowed to put into super that would be tax-free. So a number of governments ago that went out, but what they've done is brought something similar back in with these 1.6 caps. Does anybody remember the RBLs when they were around? Yeah, maybe it's just you and me, yeah. Okay, so there's a little bit of background here so then I can show you some of the strategies. So when we pay a pension from a super fund, there's 2 different types of pensions that we can pay. The first one is called an account-based pension, and there's 3 different age categories that apply to this pension. So we're a bit technical here, so just bear with me. If you are between aged 56 and 60 and you have stopped working, you can start an account-based pension, and you need to withdraw 4% of your member balance. Now, there's a few tax consequences when you're between 56 and 60. Hands up who's in that category that has started a pension. Yeah, a couple, but not many, yeah, okay. All right, if you are in the age bracket, we just lose our little message. If you are in the age bracket between 60 and 65 and you have stopped working, you can start an account-based pension. The pension that you are paid is then tax-free to you, and of course you have to take a minimum out. We have a third age group for account-based pensions, and that's the age 65 and over. Now, when you are over 65, you can start an account-based pension and take your superannuation out tax-free. You don't have to have stopped working. So that's the difference. Over 65, you can start your pension. You can still be working if you like. Under 65, you need to have stopped work to start your account-based pension. Now, again, as we get older, our minimum pension withdrawals increase every year. So at age 65, they're 5%, and there is this scale that increases over time. The second type of pension is what we call a TRIS, or a transition to retirement income stream. And this applies to anybody between 56 and 65. This is when you are still working, but you want to take some money out of your superannuation, and you can take between 4 and 10%. And this has had in the current year and in the past, there's been huge tax benefits of doing this, because what it meant is when you entered a TRIS, whatever your balance in your superannuation fund was, the earnings on that balance would be tax-free. That was the current rules. I'll talk in a minute about the change in rules. So, show of hands, how many people in the audience are on a TRIS? Yeah, okay, so you guys need to pay attention when we talk about some of the changes in rules. So, let's talk about the tax impact of these two different pensions. So remember, we've got an account-based pension and a TRIS. On the account-based pensions, they are essentially tax-free when they come out to you. Special rules, of course, if you're under 60, there is a slight taxed element. But the big thing about going into the pension phase is that the income and the capital gains in the super fund become tax-free. So we all know outside of super, our top rate of tax at the moment is 49%. Within super, if we can get it to the 0%, obviously we have a large saving. So the tax impact of the TRISs, when you are receiving a pension and you are still working, you get a tax rebate for that pension. But the big thing, as I mentioned, is the income and the capital gains tax. Capital gains in the super fund are tax-free. One of the huge changes in the budget is that for anyone on a TRIS, the income and the gains in the super fund are no longer tax-free. So we need to change strategy for anyone on a TRIS. We need to relook at the circumstances, and we need to see whether it still will be a tax-effective way of running their super. That's not a good change, that one, is it? No, it's not a happy one, that one. Okay, let's have a little bit of a look at some of the taxes payable by super funds. Now, generally when you contribute to super, and we know that limit's going to fall to $25,000, generally you pay 15% tax on those contributions. If you have an income above $300,000, and that income is what we call an adjusted taxable income. So that means that's your salary, it's your super, it's any negative gearing, it's any reportable fringe benefits. So it actually doesn't take very long to hit that $300,000 when you add all those categories together. When your income is more than $300,000, you don't pay 15% tax on your super, you pay 30%. It's called a Division 293 notice. So, and we do see a lot of them flooding through our client base, and there's some strategies we use to try and keep people under those amounts. But what the government's announced in these changes is that level drops to $250,000 from 1 July 17. So this is the last financial year where that level will be at $300,000. So something else that we need to plan for, definitely. Pointing out though, even if your super is taxed at 30%, you are most likely on the highest marginal rate of tax outside super, which is 49%. So still a saving for you having money in super. Okay, how are we going? This is the time where we need to pause, we need to wriggle in our seats, we need to just get our energy back a little bit. Because what I want to share with you now, the second 1.6 million cap and the impact that that's going to have for you. So turn, smile at the person next to you, get yourselves ready. All right, a little bit of movement, that's good. It's a very, very exciting topic, superannuation, isn't it? We all feeling excited this morning? Glance out to the nice, calm, green Shark Park Oval before you glance back. All right, so we have a second $1.6 million cap. Now, it's got a fancy name. It's called a transfer balance cap. And all that means is the maximum amount that you can have in your super fund in pension tax-free. So the first 1.6 cap was the limit that you could put into super, and the second cap is the amount that you can have that is tax-free. So what that means is if you have a balance of greater than 1.6, this is per member, not per fund. So you can have a 2-member fund with a $3.2 million balance. Any balances above 1.6 will go back to being taxed when you are in pension phase. Any balances under 1.6 will remain tax-free. So is this news to anyone? No, good. See, you're so smart, guys, so smart. Okay, so what happens when you have a member balance above 1.6 mil, you have to transfer back to accumulation the excess. That's an accounting entry, we sort of do that, but just so you understand, the 1.6 is crystallised and the balance is rolled back into what we call the accumulation phase. Okay, it gets a little bit more complicated. So what the government has said is that as at this June 2017, we need to, as we normally do, we need to make sure all assets in the super fund are at market value. Because what they're allowing is they are allowing any CGT after this date to be based on the market value as at June 17. Have I got that right, Terry? Good, I got that right.
For assets transferred back to accumulation.
That's right. So this area is a little bit complicated. If you're in this boat, we'll speak to you directly rather than bore everyone with the complicated detail. But we just need to be aware that when you have property particularly, shares are easy because we have a listed valuation, but when you have property particularly, very, very important that we have a correct market value as at June 17, subject to everything else that's into play, but the correct market value so that we can be crystallising capital gains at the right level. So anyone that plays around with their market values, which would be no one in this room because we all do the right thing, but we really need a proper market value as at June 17. Okay, so as mentioned, what happens is if you've got a balance of more than 1.6, any earnings on the excess of that balance will be taxed at 15%. Any capital gains on the excess of that balance will be taxed at 10%. So my point to everybody is that really so bad? So let's say in your fund you've got a balance of, pick a number, let's say you've got $1.8 million and you're in pension phase. The $1.6 million, the earnings on the 1.6 will be tax free, but the earnings on the extra 200,000 you will need to pay some tax on. If, for instance, you've taken some of Andrew's tips and you've bought some shares and you've bought the ones that pay fully franked dividends, gotta love Lend-Lease, but there's no franking credits there. What happens is within a self-managed super fund, when you get franking credits, they come in at a 30% tax rate because the company that's run their business has paid tax at 30%. Super funds pay tax at 15%. So the more franking credits we have, the more tax it covers in the super fund. So if you have a fund worth $1.8 million, let's say it's got some shares and some property, what you might find is that the franking credits from these dividends cover that extra tax. So my question is it really so bad? And the other point to note there again is on the difference between the tax rates between the super funds and your personal rate of tax. So you might think that, yes, I'm getting close to that 1.6 mil. I'm not sure if I really want to be putting any more money into super because of the tax implications of it. But what you need to think about is if you left that money outside of super and you invested it, you would pay tax on that in your own name at your own marginal rate of tax, which could be up to 49%. If that money sits in your super fund, then you're paying tax on it at 15% or 10% on capital gains. So still a much lower rate of tax. Is everyone getting that? Yeah, good. Like some nods, thank you guys. Okay, now the other point to note, and anybody that owns shares that's in pension phase will know this, but when you have excess franking credits in a super fund, they are directly refunded to your fund from the ATO. So we have a number of super funds that get quite sizable tax refunds every year because of these franking credits. It's a nice little system, that one. We like to work a few systems. So let's talk about very happy subject of death. Let's talk about that and the impact of death on super funds. Now, what often happens in a super fund, particularly a self-managed super fund, in fact, only a self-managed super fund, we often have a system in place that is called a reversionary pension system. And what happens if we've got husband and wife, let's say the husband has $1 million super fund balance, let's give the wife 1.5, shall we? That's nice, isn't it? Should we be nice to the wife today? So what happens on death? If they have a reversionary pension system in place, when the husband passes away, well, let's get rid of him first. When he passes away, his balance then transfers across to the wife. So before death, we've got a $1 million balance and a $1.5 million balance. We both are still tax-free. On death of the husband, his $1 million balance transfers over to the wife, and her balance is now 2.5. What are we doing, Jen? Don't you love technical faults in presentations? Anyway, so the wife is now very happy that she has a $2.5 million balance, but it will only be tax-free to 1.6. So the reversionary pension strategy is a very good one, but we have to now watch this taxed element above 1.6. Who knows if they've got a reversionary pension strategy in place in their fund? Good job. Yeah, a couple of you. There might be more of you that don't know that you have it. Okay, a couple of things to watch out for. There's many people out in the marketplace that has more than one super fund. Some have a self-managed super fund, some have lots of super funds everywhere. But this $1.6 million cap is across all funds. So you can't just look at your self-managed, you can't just look at your industry fund, you can't just look at your retail fund, you have to look at them all together. We have to watch, of course, that we don't exceed that cap across all funds. We definitely need to watch out for our contribution caps. We know we can put $35,000 or $30,000 in this year. After this year, we know it drops down to $25,000. The next thing that we need to look out for is our non-concessional contribution caps. So anyone with excess money outside super that might be sitting in some sort of investment outside super, this is the time to be thinking about, should I be liquidating that investment and putting that money into super? I'll talk about that a little bit more in a minute. But where we can get up to $540,000 in this year, it is a very good opportunity to try and take advantage of if we can. After this year, we know that we drop down to $100,000 per year or $300,000 for the 3-year brought forward. We know after this year as well that we need to watch out for our pension cap, where our super funds will be taxed at our balances above 1.6 in pension phase. Okay, so that's all fine and good and all interesting and all very factual, but what you really want to know is what strategies can you use to get the best out of these new rules. Is that right? Yeah, we all want to know what we can do about it. Okay, so a couple of things for you to consider. The first thing that everybody really needs to do is they need to check their balance. How close are you to the 1.6 mil? How close is your spouse to the 1.6 mil? Have a look at all of the funds that you've got, add them all together. Think about whether you can be contributing to super this financial year up to the maximum limits. Now, if you have a member balance that's greater than 1.6 mil, and we have a number of clients that do, this financial year is the last opportunity for you to put any non-concessional contributions into super, ever. So I'm working on a number of strategies with different clients at the moment, and one strategy that works particularly well is where commercial property is owned outside super that is used in the business. And what I'm doing with these clients is we are actually moving that commercial property into the self-managed super fund. Now they may need to put an amount of money into the fund to fund the rest above the borrowing. It may be that there's enough money in the fund already. But we are using this particular NCC $540,000 limit to get the money in, to then get the commercial property in. So what happens in the future for these people is that whenever they sell this commercial property, hopefully they're in pension phase then, and hopefully then they can sell that property tax-free. The other thing to think about is if they continue to hold that commercial property outside super and they're in retirement, the rent on that property will continue to be taxable to them. So an example of a particular client I'm doing this strategy with at the moment, the annual rent on his commercial property is $166,000. If I leave that property in his name, when he retires, he will pay tax every year on that $166,000. If I move it into his super fund, subject to the 1.6 rules between he and his wife, that $166,000 should be tax-free every year to him. Now that's a saving of about $50,000 per year in income tax, just by using this strategy. So I would encourage any of you that have assets outside super to be talking to us and making sure we are really optimising how you hold those assets. Because again, this financial year is the last opportunity with such a big NCC balance to do something about these assets. So we definitely need to be thinking about this. Okay, if you've got a super fund and your wife's balance is $400,000 and yours is 1.4, if you are putting some contributions into super, we would need to think about where those contributions are allocated. If we can increase the wife's balance and keep your balance a little bit lower and try and get you both closer to that 1.6, then that's a strategy we need to work with. So another strategy to even up those member balances is a pension recontribution strategy. So if you can take out the pension from your account, but you can put it back into your super fund, into your wife's account, we are more able to even up those balances, because remember, we both have the 1.6 cap. So again, these are things that we need to be thinking about. Have a think about the timing of selling personal assets. Now, in your notes, I did notice 10 o'clock last night when I was reviewing this presentation, we did have a little typo. When you go to that slide, you'll have 2016 written there. Just write over it and make sure it's 2017. Any assets that you wish to sell into a super fund have a capital gains tax implication. So these commercial properties I'm talking about, there is a capital gains tax implication, there is a stamp duty implication. Now there's some special rules that help us often get out of both of those taxes, but any time you sell an asset, even if it's to your own super fund, you have to be aware of the tax implications of doing so. So obviously talk to us about those. So, as I alluded to before, we have to make sure that our asset valuations as at this June 30 are very accurate, and exploring the option of putting any commercial property that you own outside super into a super fund. Okay, some real life scenarios. So what I'd like you to do as we go through these scenarios is try and find the category that you fit into. So I've tried to broaden these enough so that we all fit into a certain type of category. Let's see where you fit. Okay, let's look at our first scenario. Now, all of these scenarios apply from 1 July 17, so next financial year. So let's say you have a fund that has less than 1.6 per member balance and is not in pension mode. So this is a lot of people. This is a very broad category. This is where we are still working, we're not in pension mode, and we don't have 1.6 per member. Basically, for this type of fund, it's status quo. Your earnings are still taxed at 15%. Capital gains are still taxed at 10%. Now, a point to note, outside super, generally capital gains are taxed at 25%. So again, we have a much lower tax rate in super versus outside super. So status quo, capital gains at 10%, concessional contributions up to $25,000, and your non-concessional contributions $100,000 or $300,000 on the brought forward. So this will cover a lot of people. It will just be status quo. Let's say you've got 1.6 mil, happy days, we're in pension mode. Again, we have status quo here. We've got earnings on the pension are tax-free, capital gains are tax-free, concessional contributions up to $25,000 if we can get around some rules, and non-concessional contributions $100,000. So when our balances are under 1.6 mil per person, mostly things haven't changed a great deal. It's where we get up to our greater than 1.6 balances that we really need to have some specific strategies. So if your balance is greater than 1.6 mil and you're not in pension mode. So a client of mine that I'm working with at the moment, he's a doctor, both he and his wife, they have member balances above 1.6 mil. He's not in pension mode, he's still working full time. So I met with him last week, and he has a share portfolio outside super. And what we have decided to do is look at that share portfolio, see where his stocks are up and stocks are down, but we're going to move we're actually going to move $1,080,000, so $540 for husband and wife, into super. Because they're at 1.6, this is the last time ever that they can put any non-concessional contributions into super. So he's going to take $1 million out of his personal share portfolio, sell it to his super fund, still own the same shares because he's just going to move them across. He has got capital gains tax to consider, but that $1 million will now sit inside his super fund. That making sense? So you need to, so the assets that you're looking at outside super to get into your fund, because in super funds we know we have asset protection and we have low tax rates. So you could be looking at cash that you hold, you could be looking at shares that you hold outside super, you could be looking at residential real estate that you might sell to put the cash into super, or you could be looking at commercial real estate that can possibly be transferred into the super fund. A few different categories. Because I know we've all got a spare mill sitting out there that we can just throw into super, but people do. People definitely do. Okay, so that's when your balance is 1.6 and you are not in pension mode. When your balance is greater than 1.6 per member and you are in pension mode. Let's have a little look. So example is we have a 2-member fund. First member has a balance of 1.2, so this member's okay, they're under the 1.6. Second member has a balance of 2 mil, so obviously over the 1.6. So we're with me, we're on this fund. What happens? Member number 1, status quo. Earnings, capital gains are still tax-free. Member number 2, this is where it changes. What happens is, of their $2 million balance, the earnings and capital gains on the 1.6 are tax-free. Any earnings on the $400,000, which has been transferred back to accumulation, become taxable. Our second member can again never put anything extra into super because they've already reached that 1.6 cap. So if anything goes into their super fund, we have a little bit of scope with our member 1 at 1.2 million, but our member 2's already balanced out. So a lot more consideration needs to go into planning for superannuation when we're up around close to these 1.6 balances. Terrible problem to have, huh? Okay, last scenario, and this one gets a little bit complicated. We have a few people on transition to retirement pensions or income streams. So what happens is we have to look at these very closely because we know in the past that when we've been in a TRIS, our earnings on our super have been, on the balance in our super fund have been tax-free. That exemption is gone. So if we're in this category and we haven't satisfied a condition of release, most likely the outcome is we will exit that TRIS and go back to a normal accumulation fund. If we have satisfied a condition of release, does anyone know what a condition of release is? So much jargon. Some people. Condition of release is when you've retired or reached age 65. Yep. So if you're in a transition to retirement pension and you have reached a condition of release, the best plan is to put you into a full pension. If you haven't done that, then really the only thing we can do is roll you back to accumulation. But again, anyone with a TRIS we need to speak to directly because we need a new strategy. The old one just doesn't work anymore. Okay, how are we feeling? We're all a bit brain dead from superannuation numbers. Very exciting topic, like I said, but there is a lot of opportunity. So it's important in this financial year that we take advantage of that opportunity. All right, so I know there will be a number of questions. We have a mic that can go around. All right, so I want you to think about your circumstances now, guys, and I want you to think about how this is applying to you. And let's just talk through some scenarios together, because the more that we talk through examples, the more people understand. So who's got a question on the change to super rules? Yep.
With reference to the valuations of properties on the 1st of July.
Yep. Can everybody hear this? We're talking about the valuations of properties on 1 July.
How do you value it? Is it just approximate what we've done last time? And I presume that the valuation's only got to do with the 1.6 million cap.
Well, any asset in a super fund has to be recorded at market value each June 30. So as we've said, with listed shares, that's easy. With property, so Terry, do you want to speak on the property side of things?
You're right. All assets have to be valued at market value. So what will happen if you have excess of over 1.6? A certain amount has to be transferred back to your accumulation, and it'll be done. There'll be pro rata calculation to have a new starting point for the assets and super in accumulation. So it's quite tricky.
So the market valuation could have a lower one.
There's no right. I would suggest you'd have a higher one, but market value is market value, so I can't influence that. But the market value obtained becomes your starting cost base for capital gains tax for the money that's in accumulation, or the members' balance in accumulation.
So an interesting thing to note there, Kevin, let's say you've got a balance of 1.6 million as at June 17 and it's in one property, just to make it an easy example. So at that point, and you're in pension phase, at that point your super fund is fully tax free. Now if you hold that property then for the next 15, 5, 10 years, doesn't matter, and that property value increases, your super fund balance is going to be above 1.6, let's say it goes up to 3 mil, but the earnings will still be tax free because you've crystallised it at 1.6. So the important thing, I would agree with Terry, is that you probably want a more generous market value rather than a less generous as at June 17, because you want to be crystallising that capital gain at the highest value possible. Does that make sense to everyone? Yeah.
The ATO may be looking at this quite carefully because you start to move towards the anti-avoidance rules. You know, if you manipulate numbers, that's why if you rely on a licensed valuer, that could be a more responsible position to take. And then you say, what is market value? Is it net market value? Is it after agents' commissions? You know, this is the hard part. That's why if it gets critical, I'd be looking at getting a licensed value rather than just the curbside valuation.
So what we tend to ask of our clients at the end of each financial year is to give us a market value on their investments. Now, that can be a value from the local real estate agent, which we actually cross-check that to RP data to make sure it's roughly reasonable. If again, as Terry said, if it's a critical issue, it might be worth getting a paid valuation on some property to make sure we're getting the right value. Now the ATO has in the past said that they will accept the real estate valuations, so there's no problem doing that, but it's just making sure that we get, you know, roughly the right amount in there.
The only other question is that you were saying to get as much into super by say transferring shares or your personal, but that's not applicable if your fund is at the cap?
This year it is. You have up until June 30 to get money into super if you are over the cap. So the cap starts on 1 July. So let's say you had a balance now of 1.8 mil. And you had some money outside super, you can put up to 540,000 into your super fund before June 30. This is the last time that you can do it. Because if your balance is 1.8 and you go past June 30, you can never put any more in. So we now have, being February, we have a 4-month window of opportunity to get the money in. And this is why anyone with a balance at or close to 1.6 in their fund really needs to be looking at this now. Yeah.
Can I just qualify that? You may have already utilised the portfolio.
Thank you.
If you have, you can't do another 540. So you need to look at when you've utilised the brought forward rules.
Yeah. So the 3-year brought forward rule says in any 3-year period you can put 3 times the contribution level in. If in the past year you put 3 times the level in, then you can't do it this year. So again, speak to us specifically because we have that data on all the funds that we look after.
In pension fund. Yep. Can you hear me? Everyone hear me?
Yep. I'll repeat the question anyway. Yep.
Pension fund with 2 members.
It does, yes. So the question is, if you have a super fund that's in pension phase and you have 2 members, then of course you can have 3.2 million in there and still be tax free. But you have to be a bit careful. Each member has to be below 1.6. So you can't have one at 3 mil and one at 200,000. The cap is at 1.6 per person.
Yes, when I read about that, I was sure it was 1.6 for the whole thing, for the whole fund.
No, it's per person. So the 1.6 is not for the whole fund, it's per person, per member. Yeah. All right, who's got a nice juicy question for us? You promised me one, Rod. What have you got, Lucy? Yep.
Non-concessional contributions also taxed at 15%?
No. Non-concessional contributions are not taxed when they go into your super fund. The only contributions that are taxed are the $25,000 concessional contribution. So if we're talking about putting $540,000 in, it goes into the super fund tax-free, and what we're looking for in that fund is the concessional tax rate on the earnings and the capital gains. So the reason why the non-concessional contributions are tax-free is because they come from after-tax money. So you've made some money outside super and it's either sitting in some form of asset or whatever, but it tends to be from after-tax money that goes into the fund and it doesn't get taxed when it goes in. Yeah.
1.6, that's been indexed, is it not?
By $100,000, but you have to wait a few years for that to be reached.
We might all be dead before they start indexing the 1.6, but it is forecast to index in 100,000 increments.
1.6 is 16 times $100,000, and no mathematician to work that out. So the government decided $100,000 is what you need, times 16. There's some logic in it, but it just hasn't sunk in there.
Sorry, I mean, just to clarify, is it going to be, it's not going to be indexed every year?
No,
Right.
no.
It's indexed in 100,000 chunks. You just have to wait for the indexation to get to 100,000.
Which could take some time, because aren't they linking the indexation, Terry, to CPI?
Whatever.
So it could take years and years. You know, it's funny when you talk about the 16 years, I think they think everyone will live for 16 years in retirement so that you can have some money for 16 years and that's it. So nobody live longer than 16 years after you retire and we should all be fine.
Jenny, you said that the valuation of a property is as at 2017.
Yeah.
So let's say I have a property worth $500,000
Yep.
and my super fund is fine.
Yep.
But in 5 years' time or in 2 years' time,
Yep.
it might go to $1 million. So
Yep.
it no longer matters.
Yeah, that's correct. So the question at the front is, if you've got a property now that's worth $500,000 and you're beneath that 1.6 threshold, what happens as the value of that property increases and you go over that 1.6? And as I mentioned earlier, it means that it remains tax-free because as at the crystallisation point,
So that's
it is below the value. Yeah,
That's provided that you're in pension at 1 July 17.
that's right. That's right. So for you, Ella, if you are in pension as at 1 July 17 and the property is under, or if your whole super balance is under 1.6, if the property value increases, it won't matter. You will keep that tax-free status. And thank you, Scott. So if you are not in pension mode as at 30 June 2017, then any increase in that value of the property will contribute to that $1.6 million cap.
So it will have to be valued every time you put in a tax return?
Yes, which we do anyway.
Yeah.
It's, yeah.
Sorry, so if you've got 1.6 million
Yep.
now, you're not in pension mode, and it grows,
Yep.
then you're saying if you are in pension mode now that it's tax-free,
Yeah.
but if you're not and it grows,
Yes.
then that growth is taxable.
It's not the growth that is taxable, it's the earnings on the growth. So let's
If you're
say,
in pension phase now, it wouldn't be.
correct.
So there's two different treatments.
That's right.
Where you are,
Yes, that's right. Yeah, yeah.
If your accumulation, the growth has been, if you go past 1.6, you hit your cap. So you can't make any more non-concessional contributions. It's simple, isn't it?
Yeah, really simple. But I think the main message that I want to get out to people is don't be alarmed by this because yes, you may have an element of your super fund that's taxed, but it may not be such a great amount of tax. The tax rate is only 15%. Franking credits may cover the tax. If that money was held outside super, most likely your tax rate would be higher. So don't be alarmed by being taxed over 1.6 mil.